Hello and welcome to this very special Diwali edition on Moneycontrol. I'm Mahalakshmi and I have with me Arunagiri Nallasivam from Trustline Holdings. He's the founder and CIO and he follows the value school of investing and he's going to give us a Diwali pick for this year. Thank you so much, Arun, for accepting to do this. First of all,
Thank-
I want you to articulate your philosophy very quickly in terms of, what are the parameters that you really look at while picking a stock for your portfolio. And then, of course, the pick for the year.
Thanks, Mahalakshmi, for having me in this show. Appreciate it. And let me also take this opportunity to wish all your viewers a very advanced and happy Diwali. And thanks once again. As you rightly said, we come from value investing, school of value investing, right? If you look at our stock selection, primarily, we give a lot of emphasis for quality of business and quality of management. Of course, valuation is very important, but the primary thing which we look at is the choice of business, right? So, quality of business, when we look at, primarily it boils down to whether the business is very simple to understand, whether the revenue stream is predictable, and whether it's a very whether it's not very capital intensive and very capital efficient, right? Businesses which are very capital efficient, they deliver a very high ROCE, and and beyond that, I think we also look at in terms of what is the competitive edge the business has got. Does it have a durable moat? So these are very important. So the choice of business and the quality of business is where we start looking at a particular stock pick. Then, in terms of quality of management, whether you have the right, capital allocation policy, whether the management is sticking to knitting, are they focused on their core competency, and in terms of related party transaction, in terms of capital allocation, do they score much higher? So, once you get a good business and coupled with a high quality management, then the stock becomes high quality stock, high quality business. So primarily our stock selection process, if you look at it, revolves around picking high quality small or mid caps at a substantial discount to what it intrinsically worth. That's all it boils down to. When we mean high quality, it's quality of business, quality of management, and quality of earnings in terms of whether the business has got pricing power, whether it has a durable edge, and can it deliver above average ROC, ROE, return metrics, and above average operating margin. So these are the filters we use in terms of stock selection, Mahalakshmi.
Sure. You all make it sound so simple, but it takes a lifetime to understand what is high quality and what is a durable moat and what really is a good price. But anyway, go ahead. Please give us you can make the investment case for your stock pick for this year.
Yeah, Mahalakshmi. Yes, you rightly said. I think it requires a lot of expertise. In the last 2 decades, we've been, all that we have done is doing this high quality small cap investing. The last 2 decades. So we have developed a kind of expertise in this space. So the opportunity which I'm going to be talking about is from the auto ancillary space. When you look at auto ancillary space, it's primarily a B2B and a OE kind of a business, right? So in general, auto OE business is not a very attractive business because it's B2B, also to original equipment manufacturers. So the business may lack pricing power, right? So, but unless it is into a specialized area where it is into a critical component or high precision component. So we are talking about one such business which is into specialty fasteners. They are the second largest fasteners in the country, and they enjoy a very high level of criticality. As a result, this particular opportunity is, today it's trading at a substantial discount to pre-COVID level. The icing on the cake for this particular opportunity is their recent entry into the EV component space, that too in a powertrain space, which is a highly critical item. And they've got into this business of motor control units, and that business looks very promising. And if you go a little more into details, I think their auto business has come off from a very very slow cycle for last 2-3 years. So in terms of prospects and outlook, it is really promising. And if you look at the fasteners business for Sterling, the company name which I have not shared is Sterling Tools. So if you look at the fasteners side of the business, they have very very diversified revenue profile, Maha. So you have, various sectors. CV constitutes about 25%, two-wheelers about 90%, passenger vehicles about 23%, and then you have off-road and tractors along with that. Along with tractors about 18%, and the balance comes from off-market as well as from exports. So they have a very, very diversified revenue profile, and the cycle is looking very strong. So they might get into a high growth cycle like how they did in 2017-19 cycle. So something like that is likely to happen. That is on the fastener side. And you look at the MCU side, which is the EV side. Currently in FY21, they did about their revenue share of MCU business about 8%. And that's likely to go to 37 to 40% by FY25. And the forecast is FY23 probably they will touch about 200 crores from MCU business, and that might scale it up. They might scale it up to about 500 crores by FY25. So all these, when we put it on the model and look at it, this CAGR growth for top line and EBITDA as well as PAT, they look very, very robust. We are talking about 26-25% on the top line as well as on the operating profits, and close to about 40% CAGR in PAT over the next 3 years. And you put this model and look at the intrinsic value of the stock by discounting free cash flow, because they generate close to about 50-60 crores per annum free cash flow. That itself is about 6%, FCF yield on the current market valuation. If you discount it and see, you get a substantial margin of safety in the current valuation. Current market cap is about 800 crores, and FCF discounting, if you do, that gives you about 35% margin of safety. The other way of looking at the entire valuation is to do a sum of parts, right? You take the fasteners business at 15 times 1 year forward, and then give 2 times the top line for the EV component business, which is MCU. Then you get again somewhere close to 40% margin of safety. So it's a growth at a discount kind of an opportunity. So it is not a pure value for value sake. It is growth at a discount. So which means you are getting a high quality business at a significant discount to what it is worth. So we might see a re-rating like what this stock is currently in 2017-18, when the cycle was favorable, it was quoting at 6 times book. Today it's at about 2 to 2.2 times book. So what is the headroom for the stocks re-rating once the cycle turns favorable. So this is a
Sure.
very, very attractive opportunity for us.
Sure. So a few questions come to mind, Arun. One is, like you first pointed out, in your approach is to have companies which have high quality earnings and which have a deep moat, right? Does this company really have a moat?
Yeah, in terms of let's look at fasteners business. MCU is the latest recent business. But if you look at the fasteners business, you have very limited players, Maha. The leader in this business, if you look at the top player is Sundram Fasteners, and the second
Correct.
largest player is Sterling Tools. And top
Right.
player has got about 40% market share, and Sterling Tools, in our estimate, is around 25% or 26-28% market share. The rest is unorganized. And these two people, Sundaram as well as Sterling, they are slowly moving more and more into specialized fasteners. Their share of specialized fasteners has moved to about 35, and it's likely to move much higher level going forward. And that gives a kind of pricing power. If you look at historically, their operating margin, they have varied between 16 to 18%. It is very difficult to find in an auto ancillary business which delivers close to 20% operating margin. Unless you have pricing power, it is very difficult in a B2B business like auto ancillary. Most of the auto ancillaries, you will find the operating margin at around 10 to 11, 12%. Whereas here, even in the cycle which is not favorable in the last 2-3 years, their operating margin, that is EBITDA margin, has been around 14, 15, 16%. Now, as they as the cycle turns favorable, they will probably move closer to 18, 19, 20%.
Tell
So
me, so
they do,
operating
yeah,
margin is one thing. Does it translate into good return ratios? I mean, what is the capital efficiency and what is the capital output for the company?
correct. So currently, I think it is a little depressed. I think it is single digit in terms of ROE and all that. That
Hmm.
reason is because they had gone in for a greenfield investments about a couple of years back in Karnataka, which is underutilized. It is less, it is utilized to an extent of only 40%. So because of that capital investment, currently optically your ROE is looking little depressed. But as the cycle turns and as the numbers and volume goes up, and since it's already capitalized, you will start seeing these numbers getting reflected both in ROC and ROE. You have to go
Fair.
back and see what kind of ROE and ROC they delivered 3-4 years back, which is above,
Okay.
mid-teen, I would say.
So what is the long-term average in terms of ROC?
It would be somewhere in the 13 to 14%
Okay, okay,
for the company actually.
okay. And now,
Because asset turn, as yeah, please, yeah.
and what is the debt equity? I mean, are they still loaded with debt?
No, that's one thing, we don't, our philosophy look at, we always look for companies which are where the balance sheet is extremely clean and they don't need too much of debt to grow. And that's fundamental to our stock selection. So that way, I think this, if you look at the balance sheet, in spite of their capex, which they carried out on the Greenfield project, it is running only at 0.2 to 0.3% in terms of debt to equity.
Sure. So what is the fundamental risk that you really see to this business?
Yeah, so the
Is-
risk is coming from, in our view, I think there are two ways. Fasteners is a very mature business, right?
Yeah.
They have a
Yeah.
fantastic relationship with all the OEs, the long-term relationship with most of the auto companies, and they have a high, I would say, the high quality product in that category. But the risk is more in terms of from the new EV business, right? So, it could get commoditized. MCU, currently, there are only, most of it is imported, and Sterling is one of the, I would say, first mover in terms of motor control unit. But you are going to see more players coming into the market soon. That could be one risk, one has to watch out for. The other risk is, I think, the growth rate we are assuming for EV business, it is at 30 to 40% CAGR. Now, as you see, as EV penetration, though it looks solid, going by the recent incidents of fire accidents, one is not sure whether this growth rate would materialize. We do hope with all these large players like Bajaj Auto and TVS Electronics and Hero coming into the market, I think the market would mature and probably it will get consolidated around the large players. Once they start becoming a serious players in the segment, I think the growth rate, what you would see, probably would go up. But at this point of time, that's a risk to watch out for.
Fair enough. So primarily on the EV side, the competition comes from imports, right? And what is the, do they
Currently,
have
it's
any
important.
pricing advantage? Do they have
So
any?
it is, yeah. So currently there is not much because a lot of it is imported even in their manufacturing.
Hmm,
So
hmm,
the reason why they chose to go with MCU is
hmm,
because you might, the MCU is not a pure hardware. You also
hmm,
have a firmware component, which is an embedded software, right? So more and more you customize your firmware and the
hmm.
embedded software, you will have more control in terms of your, in terms of your offerings. The OE will get more and more get locked with you, and it becomes more sticky business. At this point of time, it is not an advantage because it is, 70-80% of it is imported. They have a joint venture with a Chinese company, which is GTech. Now, so mostly it's a borrowed technology, right? And a lot of it is imported. So there is no differentiated offering at this point of time. But as in the coming months and days, I think the company has plans to customize firmware to each of these OEs, to that to make it more sticky to their clients, which will give them some kind of durable competitive advantage over time. And
Sure.
that's one of the reasons why they've entered the space. And it's also a significant cost to the final end user cost, right? The MCU in a two-wheeler costs about 10,000 rupees. So which is not very, it is a material cost to the final end product. So the criticality is very important. And to that extent, I think over time, I think this business also will generate higher margins and return ratios once you have offerings which are more customized.
Sure. So, do this? What? How confident are you about the OEMs actually preferring them as a EV play? Because one of the things in EVs is that you don't really, the way it is, the industry has developed in China. Also, it's very fragmented, and it's about just getting a few things and assembling it and pushing it out. So somehow the stickiness that these companies ancillaries used to enjoy with OEMs in the IC space is now shifting, because nothing is so critical that you can't just pull off from an import and put it together.
Yeah.
So in that sense, will they be? Are you confident that they will be able to make a sticky business out of this EV play?
Yeah, I think you're right.
Because
EV is
that
a
will
very,
be
very
critical to sort of sustaining that business on a growth path, because the
uh,
other
uh,
part of the business may be challenged
yes.
also.
Absolutely, Maha. Actually, as you rightly said, EV two-wheelers is a very, very fragmented market. You have all sorts of players. That's one of the reason, you see all these accidents, because fundamentally quality is suffered in that space. Now with consolidate, the large players coming into the market, and the market is expected to consolidate around these large players, I think the quality will be given more importance. And in that, I think Sterling Tools will have a very serious say once the large OEs come into the market, and they are already coming in. And also in terms of traction, this particular business they entered only in 2020, right? And they've got a large order already from the top OE, right?
Okay.
And and they have an engagement going on for going with about 10 other OEMs, right? The large player, one particular order was 160 crores. The company's top line in FY21 was just 450 crores. You can imagine
Mm,
the kind of
mm,
numbers which is likely to come out from the MCU. And the same large OE, the top OE, which placed about 160 crores, there was a repeat of top up order of another 40. So that made it up to 200 crores, which is their order book. And and they have another LCV which is now come into their clientele. So I think the traction they are showing is very, very good, and the product which they chose tells you that they are looking at a very, very long term, very long term in terms of their business outlook, because they don't want to get into anything sundry in this space, because they want
mm.
to see value add, and that value add and the stickiness is going to come from customizing the firmware around MCU,
Sure,
and
sure,
by localization, more localization in MCU hardware.
sure. Is there any institutional holding in the stock, Arun, right
At
now?
this point of time, I'm not sure whether there is anyone, because the low liquidity stock and the market cap is only 800 crores. It doesn't allow many of these mutual funds and the large PMS to come into this space, because the
Right.
market cap filters won't allow them. But as the
Correct.
stock gets re-rated, like 2017-18, it was three times this level. So when the stock gets re-rated, I think the large HNIs and the PMS would probably follow suit.
Sure, sure, sure. Fair enough. So next 1 year, where would you see the stock right now? Where is it, and where do you see the stock 1 year down the line?
Actually, the stock was languishing around 120 just about 8 months back, right? And when we initiated, it was around 170. Currently, it's trading at about 225. If you have to go back and see 1 year outlook, of course, it's very difficult to say. I wouldn't like to venture into that. But if you go back and see the of their price to book ratio, which they traded even before starting the EV business, was
Hmm.
six times the
Okay.
book. So, which means even without factoring the new additional entry of EVs and their prospects, probably the stock could go north of 400, 450, 500 at some point of time in future.
Sure, sure, sure. Okay. Thank you so much, Arun. That was quite a lowdown on this talk. And I wish you a very happy Diwali. And of course, to all our viewers, also a very, very happy Diwali. Thank you so
Thanks,
much.
thanks, Mahalakshmi. Again, thanks for having me in this show. I appreciate it. And again, I would like to wish all your viewers a very, very happy Diwali. Thanks a lot. Thanks a lot for having me.